Welcome to our 2026 webinar series, America 250. As we honor our nation's semi-quincentennial, we will focus on securing financial independence for American families. Whether it be long-term care, disability, annuities, or life, insurance is all we do. And we look forward to providing comprehensive knowledge of these valuable financial instruments to assist you in best serving your clients. In today's presentation, we will look at disability insurance and the income protective benefits it can provide. Today's webinar is being recorded and will last about 50 minutes. You must be logged in the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We will answer all questions as best we can. If we do not get to your question today, you will receive a response by email. The webinar will be posted to our website within 24 hours. Today's presenter joined LLIS in 2005 and has garnered expert knowledge of disability and critical illness insurance in all variations and forms. That expertise has earned her the Distinguished Disability Income Fellow designation, and she brings you and your clients the most up-to-date solutions available today. Here to present is Kathy Bilodeau.
Thank you for tuning in today. In case you didn't know, May is Disability Awareness Month, hence today's topic. But here at LLIS, we're celebrating America's 250th birthday, so my theme will include inventors and innovators that were disabled during their lifetime that you may not have known about since it wasn't public knowledge. Throughout the presentation, you will hear some key phrases or words relating to being innovative. Today's agenda consists of why your clients should consider individual disability insurance. What goes into the quoting process? What are the features of a policy? That's what we'll be talking about in building a plan. Meeting the needs of business owners as individuals, and then those owners meeting the needs of their employees will be our business owner and employer group benefits topics. And then lastly, we will cover critical illness, which is a solution for clients that may not be eligible for disability due to their occupation or due to no occupation, such as a stay-at-home parent. So being famous and disabled, not exactly a great thing. But this slide represents people who were disabled even if they weren't formally diagnosed, but they went on to do great things and were historical figures. Stevie Wonder and both Helen Keller were both blind. Stevie Wonder learned how to play multiple instruments. Helen Keller went on to be an author and an activist. She will be one of our case studies. Abraham Lincoln, everybody knows he was president, but did you know he suffered from depression and Marfan syndrome, a connective tissue disorder? Then we have Marlee Matlin and Thomas Edison. Both suffered from hearing loss. Marlee Matlin went on to be an actress, and Thomas Edison discovered GE. John F. Kennedy, you may not know, but during his college days, he suffered from a back injury while playing football, and it was aggravated after his PT boat was ran while he was serving in the Navy. Then we have Franklin Roosevelt and Fannie Lou Hamer. Both had polio. Franklin Roosevelt, as you know, went on to become president, and Fannie Lou was a civil rights activist for blacks and women in the early 60s. Some more famous and disabled. Some of you may know Bethany Hamilton. She lost her left arm below the shoulder in Hawaii after a tiger shark attack. But she went on to be not only a pro surfer, but also an author and a speaker. And those of you who live in Florida are very familiar with Walt Disney. Walt Disney and Alexander Bell both suffer from dyslexia. In addition, so did Henry Ford, Charles Schwab, Kevin O'Leary, Steven Spielberg, and Tom Cruise. They're just a few of famous people that have been diagnosed with dyslexia, which is a neurodevelopmental disorder. Walt Disney will be one of our case studies later on. And then we have Eric Dane. Eric Dane and Stephen Hawking were both diagnosed with ALS. Eric Dane passed away earlier this year. He's going to be a case study, but we're using his persona from Grey's Anatomy as Dr. Mark Sloan, or some of you may know him as Dr. McSteamy. And then lastly, we have Michael J. Fox, who at age 29 was diagnosed with Parkinson's. As you can see, most of these people probably would have benefited from having disability insurance. So disability insurance, how did it come about? Well, in the late 1800s in the United Kingdom, the Railway Passenger Assurance Company invented insurance to cover accidents on trains. That later became what President Eisenhower signed into law in 1956 as what we know as Social Security disability. But at that time, it only covered 50 to 60-year-old workers. And then in 1960, it covered all ages. So if your client's idea of disability insurance is Social Security disability insurance, they should know that Social Security disability claims take 3 to 5 months to get a decision after it's been submitted. In addition, only 1/3 of the claims are approved. Yes, that's correct. 1/3 of the claims are approved. In 2023, there was a backlog of more than 1 million appeals cases, and the associated processing time averaged 18 months. And when you go through the appeals process, you usually need an attorney if you if you're going to have any kind of success in getting your claim approved. So why do we recommend individual disability insurance? Because health insurance covers medical bills. Workers' compensation only pays for injuries that happen in the workplace. And life insurance provides a benefit only if the insured dies. So if Social Security disability plan has gotten your attention, you should remind the client that they can purchase individual disability to supplement group coverage or as a standalone policy. Younger clients may change employers several times while they're on their upward trajectory in their career path. So it's important to have a policy that follows them from employer to employer, or if they decide to become self-employed, they don't have to worry about losing their group benefits. So in an effort to help advisors be more creative when discussing employer benefits with their clients, here are some conversation starter questions for discussing the need for disability insurance. First and foremost, ask your client, if you lost your paycheck today, how would you pay your bills? Ask them, do you have any coverage at your work? If your client says, yes, I've got it at work, there's no need to talk about it, you need to settle down with them and say you need to review the details on their plan, because I can guarantee you they probably haven't looked at it. And maybe when they fill out a quote request with us, that's the first time they're actually paying attention to it, because they have to answer the questions on the quote request. And it's also important to learn if they're earning not just a base pay, if they're a W-2 employee, but are they receiving a bonus? Or if they're self-employed, do they have distributions? Because all this is considered earned income. So in an effort to help advisors be more creative, we need to have some sort of worksheet to walk through these various points. So this is a worksheet that you can find on our website. And when someone tells you, oh, we don't need to talk about it, I have it at work, put this worksheet down, take a look at it, get familiar with it. The 3 things that are the most important is the base pay, bonus, and commissions. If your client earns any or all of those, they need to understand that group insurance doesn't cover anything most of the time other than base pay. So if they rely on that other income, the group coverage is going to fall short. In addition to that, RSUs are also covered by individual disability insurance as long as they show up on their W-2. Another one to pay attention to is the own occupation definition. The own occupation definition simply says that if the client can't do the substantial and material duties of their occupation, and they choose to, they don't have to, but if they choose to work in another occupation, they can collect 100% of their disability benefit and 100% of their income from their new job. They only get that usually with a group plan for the first 24 months, and after that, their employer would ask them to do anything that they're reasonably able to do with their disability. And then lastly, portability. When you have a group plan, it doesn't always go with you when you leave. Whereas with the individual, it will follow you from job to job, from state to state. And if you decide to become self-employed, you don't have to worry because you already have that coverage in place. So I know retirement plans for your clients is of the utmost importance. So if a client becomes disabled, it can force you to go back to the drawing board and ask them, well, how are you going to make contributions to your retirement plan? Remind them that if they depend on their 401k or IRA savings for retirement, and if their paycheck stops, so does their contribution that they're making, but also the employer matching. After all those questions, we do have a solution. Some of you might have heard that income is the client's most valuable asset and the foundation for any financial planning. I'm sure you depend on that for what you're doing for your clients. But in addition to that, your client might have auto insurance premiums. They might have life insurance premiums. Hopefully they have health insurance premiums, and they might have property insurance premiums. They may also want to put money away for that retirement plan, or if they're a business owner, be able to expand their business, maybe buy property, hire some more people. And then lastly, if they have a family or maybe a favorite charity, they want to pass on some of that personal wealth. Well, if they don't have an income for several years or their lifetime, none of this is possible. But that's okay because we have a solution. It's called disability insurance. So let's pay close attention to what goes into disability insurance. We're going to cover what is needed from conception to policy. But before we do that, I want to share a few points that you may or may not be aware of. First and foremost, disability companies do not replace 100% of your client's income, and they need to understand that as well. They cover 60 to 70% of their gross income, not their net, but their gross income, minus any other insurance disability coverage, which could be individual disability, it could be association, or it could be employer group coverage. The reason they don't pay 100% is because there's no incentive for a client to come back to work if they're receiving too much benefit. If a client has employer-paid long-term disability, it's important to know that individual disability companies will reduce that benefit by 25%. Why do they reduce the benefit? Well, because individual disability insurance companies know that the client has to pay taxes on that benefit. So let's say your client has a $5,000 a month benefit with their employer. They'll get their $5,000 a month, but at the end of the year, they're going to get a 1099, and they're going to have to pay taxes on that. So the individual disability insurance companies know that. So they allow for a higher monthly benefit with them, knowing that they have to pay taxes on the group if it's an employer-paid benefit. Whoops. So what's needed for a quote or how to get a conceptual illustration? We first and foremost need the client's name. We need to know their date of birth. Date of birth meaning that the younger they are, the less the premium is going to be. We also need to know what's their gender, occupation. We're going to go into this in a little greater detail, but occupation has a lot to do with their environment. It has a lot to do what their duties are. Are they traveling? Are they a project manager on a construction site, or are they white collar, simply in the office? Income, very, very important. We're going to be looking at this one a little later on, so just bear with me. State of residence, rates do change from state to state, so it's important to make sure we have the correct state that they're actually residing in. Smoking status. This takes the smoking of nicotine, tobacco, marijuana, whatever form it is, whether they're vaping it, they're smoking it, they're chewing it, whether it's edibles, gummies, we need to take that into consideration. And then last, what other coverage they have in force. We don't want to over-insure a client so that, again, there's no incentive for them to ever go back to work. So we need to know what individual coverage they have, what group coverage they have, what association coverage they have. So there are, when we talk about the invention of disability underwriting, there are three main models that we will explore in greater detail. They are occupation, medical, and financial. So occupation classes, as you can see from like 2A to the left and 3A to the right, varies. And the reason it varies is because when you have those lower occupation classes with more of the blue or gray collar, those particular individuals have duties or skill set that might be a little bit more riskier than the white collar or even the gray collar. So, excuse me, underwriting takes that into consideration. They may also be concerned about the environment that they're in. So they're going to have to pay a higher premium. Whereas once you start getting into more of the white collar that are desk oriented, there's less risk, less liability of them being injured on the job. As you can see, we do have financial advisor as a 3A, a 4A, and as a 5A. What makes these fluctuate is simply how long have you been in your occupation and what's your income. So the more you make and the longer you're in that occupation, the greater the likelihood is that you'll get into that 5A. Now keep in mind that we try to find an insurance company with the best occupation class for your client, so they're getting the best plan with the best features and the lowest premium. Medical underwriting. So we talked about the occupational portion of underwriting. Now let's talk about the medical aspect. These are some possible requirements for underwriting. First and foremost, you have the telephone interview. This could be done by the actual insurance company or a third-party vendor that they're using. And this is just to ask the same questions that are asked on the application to make sure there's no collusion with us as the agent in trying to get them covered. In addition, they may order a paramedical exam. A paramedical exam simply means that a nurse comes to the home of the client, takes a blood and a urine sample, takes their height, their weight, their pulse, their blood pressure, and asks them a series of medical questions. This may not be required in all instances. Most of the time with disability, we see this when people are over the age 50 and are taking on $10,000 or more of monthly benefit. Again, they could also request medical records or what we call attending physician statements. Prior to doing that, they do like to run their name through two databases. One is a prescription database to make sure they disclosed any medications they were prescribed, and then also a medical claims database to make sure that they disclosed any health or any illness or injury that their health insurance company may be paying claims on. So here's the most common reasons for long-term disability, and this is why a lot of underwriters are very sensitive when they see a background of this. So musculoskeletal usually pertains to neck or back. So when we're looking at the neck, that's more the cervical area. The middle of the back is the thoracic area, and then the lower part of the back is the lumbar. So depending upon where that is, that could be a problem with underwriting, and we'll talk about what underwriters can do. When we're talking about injuries, we're talking about fractures, sprains, that's 13%. Cancer, we're coming in at 12%. Mental health issues, the anxiety, depression, attention deficit, that's coming in at 10%. And then your circulatory, your heart attacks, your strokes comes in at 8%. It's important to note that 95% of disability claims are illness-related and not injury-related. So lots of times your client will say, oh, if I get hit by a bus or if I'm in a car accident, I can still pull myself up to my computer. The likelihood of that happening is probably very small, but even if it is an illness, you have to remember that people could be cognitively impaired by any kind of medication they're taking, so that doesn't necessarily mean that they can go back to their job. So common concerns for medical underwriters, very similar to what we just mentioned: musculoskeletal, back disorders, the cancer, mental nervous history, the heart attacks we just mentioned, circulatory, and then on down the line, diabetes, high blood pressure and cholesterol. They're not concerned about that as long as it's being treated, but if someone's sticking their head in the sand and pretending that, nothing's wrong, they're going to be concerned about that, as well as hyper and hypothyroid arthritis, and then build, which is your height and weight. If someone's overweight, that could be a concern. They can do things such as modified underwriting, and we're going to talk about that in just a minute. So I first wanted to show you declines. These are automatic declines, and the reason some of these are declines is because they're autoimmune disorders. Things such as chronic fatigue, fibromyalgia, juvenile diabetes, multiple sclerosis, rheumatoid arthritis, systemic lupus. These are autoimmune disorders, which means that when a client is diagnosed with these, it's forever. They may go into remission, but then they could have a flare, and that could make it where they can't work for several months, maybe even years. So that's why these are automatic declines. And the other ones are pretty obvious. But I just wanted to point that out, why some of these are on this list. Now we have conditions that are what we call modifications. Years ago, medical underwriting wouldn't even cover these people as well. They would be on the decline list. But underwriters had to conjure up a way to insure them, but still reduce their liability. And so modifications came about. And we're going to go into greater detail with the modifications. But before we do that, if those of you who are not familiar with a disability policy and the features, you're not going to understand what the modifications could be. So right now, we're going to go over the moving parts of a disability policy so you know what modifications can be made. First and foremost, we have the basic part of a disability policy is the monthly benefit. I just threw $1,000 up here. And then you have the benefit period. The benefit period, you can see, goes the gamut from 2 years up to age 70. The reason for that is twofold. One, you have the 2, 5, and 10 because some people, depending upon their occupation, will not qualify for an age 65. Back when we looked at those occupation classes, when you've got the plumbers, the people in construction, those people would not qualify for an age 65 because an underwriter knows that there's a greater likelihood that they could go out on claim. But not penalizing them to the point where they don't have any at all. The next feature is the elimination period. This is the period of time that the client has to wait before they can receive their benefits. Now, we don't recommend them waiting 90 days until, they file a claim. This way, they get the claim approved so that when they reach the 91st day, the benefit can start to be paid. And then we have various riders. So there's a lot of moving parts to a disability policy, but it can also allow for a lot of jerry-rigging to make the plan specific to the client's needs, whether it be, with the benefit period or the riders. But just for your own knowledge, we usually by default here at LLIS will run a policy with the maximum benefit that they're eligible for. We'll usually run it with an age 65 benefit period, and we'll use a 90-day elimination period. The reason for that is simply because most of the advisors that we work with insist their clients have at least 90 days of emergency cash available. And keep in mind that when someone is on claim, they don't pay a premium, so it's suspended. So when we're looking at riders, we're going to go in greater detail with these riders, but I wanted to explain the own occupation again. This is the rider that says in the event your client can't do the substantial and material duties of their occupation and they choose to, they don't have to, but if they choose to work in another occupation, they can collect 100% of the income from their new job and 100% of their disability benefit. In addition to that, we usually put what is known as a future increase option rider on the plan, a residual, or it might be called partial, COLA, which stands for cost of living adjustment, and then we have the catastrophic rider. So the future increase option rider is the rider that allows your client, particularly if they're on that upward trajectory, to increase their monthly benefit as their income goes up with no medical underwriting. It's simply financial. The residual or partial benefit is the safety net in the event that their doctor doesn't deem them totally disabled, but they can work in some capacity on a part-time basis. So if they're working and they're losing 15 to 20% of their income, that would be a trigger where they would be eligible to collect a portion, if not all, of their disability benefit. And then we have the COLA rider. The COLA rider only kicks in when they're on claim. So you've got the FIO while they're working to increase the monthly benefit. The COLA increases the monthly benefit while they're on claim. So as the cost of goods go up, as like today with gasoline, and food, you don't want that monthly benefit to remain stagnant. There has to be a mechanism to increase the monthly benefit, and that's what the COLA rider does. And then lastly, we have the my little catastrophic rider. What this one does is it creates another monthly benefit on top of the base benefit. So there are several triggers in order to be eligible for this additional benefit, and sometimes it can get to 100% of their gross pay. But example of triggers would be a cognitive brain impairment, things such as a brain injury, dementia, or Alzheimer's. Another trigger would be if someone loses 2 or more of their activities of daily living, things such as dressing, bathing, toileting, transferring from bed to chair, continence, or eating. And then the last one is more of a physical one. If you lose an arm and a leg, or both arms and both legs, or the ability to speak, or vision out of both eyes, or hearing out of both ears, any one of those would be a trigger. And with the catastrophic rider, it's now been increased to $12,500 per month. So again, it's on top of the base monthly benefit. This rider is good for people who have heart disease or high blood pressure or stroke or Alzheimer's or dementia that runs in the family. Oops, sorry about that. So our policy design modifications are going to be reduce the monthly benefit amount. They could maybe reduce the benefit period. Instead of giving them age 65, they only give them, a 10-year. Or instead of giving them 90-day, they give them 180. Or they eliminate some of the riders. Another thing they can do is they can rate the policy, which means they have to pay an additional premium. So maybe they're for overweight, they're paying an additional 25%. Or they add an exclusion rider. Someone's going through physical therapy on their leg. They're going to put an exclusion on that because they don't want to pay a claim on that. Mental nervous is a common one. So if someone is going through therapy or taking medication, they'll put an exclusion on that. We do have access to underwriters, so if we see something that we're not sure about, we can send the information anonymously and get some idea from an underwriter as to how to quote them. Now, our case managers are great about asking underwriters about an exclusion or a change in one of the features, about what we have to do in order to maybe get that age 65 or maybe get that rating removed. Doesn't mean that we always are going to be successful at it, but we do have something called a circle back built into our ALICE system where we can circle back to the client and see if things have improved. The third and final element of underwriting is financial, and there is extensive financial underwriting. When we are at this point of the year, we're actually going to be looking at tax returns. So we know that someone just filed them last month. We're going to look at the tax returns with W-2s so that we can differentiate between the client and the spouse's income. We are also going to look at year-to-date pay stubs. So maybe in November, December, because that's a current year versus the tax return being a prior year, maybe we'll use that as income in addition to the tax return. And then like if we're like in January, February, maybe we're looking at a W-2 because that's current. And if there's RSUs that are on the W-2, we can also count that because you're paying taxes on that. And when we have self-employed individuals and they're somewhat newly self-employed, if we could show a contract, that's very helpful as well. This way, the underwriter knows that there's going to be a revenue stream coming in right away. So earned income, which is the only income that we can insure, and again, it has to be documented, and income replacements for level are higher for lower incomes. So when someone's making less money, $40,000, $50,000, $60,000, we're going to be able to cover more of that than someone who's making $500,000 and $600,000. Typically, the monthly benefit max is going to be $20,000 to $30,000 a month. So just because you make more doesn't mean we're going to cover more. That's what the insurance companies say. If someone is making a lot, come to me. We can ask for Lloyd's of London to layer over some additional coverage. So when we have income that's considered unearned, such as rental property, royalties, alimony, trust income, any kind of income that's going to continue to flow to the client, whether they're working or not, we need to notify the insurance company and how much it is because they may reduce the monthly benefit. If you have clients who fall into the $8 to $10 million net worth, they may or may not be eligible for disability depending upon how liquid some of that money is. And then obviously if you're making over $10 million, in the eyes of the insurance company, you should be able to self-insure. So these are some special programs before we get into our case studies that I wanted to discuss with you. The New Professionals Program, it covers a bunch of different occupations, but for this purpose, I'm going to talk about the medical field. So if you have students or fellows or residents or even a doctor in their first year, the program is designed to give them a specific benefit, and they disregard any other insurance that they have. They still have to go through medical underwriting, but they don't care what their income is. And with one company, they'll actually give a 20% discount for anyone in the medical field that falls into the New Professionals. In addition, they have a program called Student Loan. So what this does is it keeps someone from having to take money out of their monthly disability benefit to make their student loan payment. This will automatically have an allocated dollar amount for a certain number of years, pay that student loan while the client is disabled. Same holds true for the retirement protection. While on claim, a dedicated amount will go into a trust fund in the client's name and accumulate money to be available at the time of retirement. So here we have our first case study. Franklin Roosevelt, when he was younger, 35, he was an attorney. He would be a 5A occupation class, and his income was $205,000. And good thing he took this policy out, because at age 39, he was diagnosed with polio. So because he had group coverage, we had to subtract that out. He had 60% to $15,000. So his monthly benefit that he was eligible for was 3,980 days, and we did the typical age 65, 90 days, and our usual riders, and he was eligible for a cat rider of $5,920. His premium as a male is $2,149. I wanted to illustrate here what it would be as a female, because this comes up a lot. Why are females paying so much more? Particularly between the ages of 25 and 45, they're paying in excess of 70% to 75% more. The reason for that is maternity claims. Pregnancy claims, maternity claims, so that's why you're going to see a difference. And here we have another case study. This is Eric Dane, the actor who did pass away, but we're using his persona, Dr. McSteamy, and he was a plastic surgeon resident, so he's going to fall into the New Professionals Program. His income was $80,000, and he was eligible for $5,000. So as a student, it's $2,500. As a resident or a fellow, it's $5,000, and as a new physician, they'd be eligible for $7,500 if they didn't want to go by their actual income. So we did the same thing, benefit period, age 65, 90 days, all the usual riders, cat rider at $2,470, and then his annual premium was $1,940. He got a discount of 30% because we used that 20% from the one company who offered it, and then he also did a 10% for a mental nervous limitation, mental nervous substance abuse limitation. And what this says is after an insured, and this is something they choose, after an insured has been on claim for a mental nervous or substance abuse, their benefits will stop unless they're in a psychiatric hospital or a recovery abuse hospital. So at the time that they're applying, if they want this discount and they're willing to take the 10% discount with this limitation, it's permanent. So after 2 or 3 years, if they change their mind, this is not something that we can reverse. Now, it wasn't for him because he's a plastic surgeon resident, but there are occupations or there are specialties within the medical field that this is mandatory. And those are emergency room physicians, anesthesiologists, pain management physicians, or nurse anesthetists. And this is because claims has showed that individuals in these fields will go out on either a substance abuse because they have access to the drugs or a mental nervous because of what they see, particularly emergency room doctors and the trauma that they see. So we've covered what we can do for individuals. Now we're going to talk about what can we do for individual business owners and their needs. So there's essentially 4 different solutions. The first one is business overhead. This is just a disability policy, so why the business owner is disabled, if there's someone available to keep the practice or keep the business going, This will help pay the month-to-month business expenses. Again, not coming out of the business owner's individual. This is a special plan just for the business. In addition to that, if the business owner has taken out a loan, again, doesn't have to take money out of their individual disability benefit. This is a separate policy or separate rider that will pay the bank or the vendor who's holding the loan on a monthly basis, that loan obligation. Key person, if you have an organization that has a person that maybe is their chief technology officer or their key salesperson and they become disabled, this is a policy that will replace some of that lost revenue. And then lastly, the more complicated one is the disability buyout. And what this one does is if there are more than 2 or 3 different business owners and one of them becomes disabled, this provides a benefit for them to have the cash available to buy out the shares of the disabled business owner. So for business overhead, we're looking for a blueprint way to keep the business operating while disabled. This is a worksheet, again, that's on our website that you can use for your business owner to complete. The only expenses on here are the reimbursable kind. In addition, I would need all the information that I would for a regular disability, you know, their name, their occupation, their income, all that kind of stuff. And keep in mind, this is a reimbursement type policy, so they have to pay the expenses up front and then they will be reimbursed for any of these. And if they don't use the entire benefit for, let's say it's a $20,000 benefit and they only use $15,000 of it, it just rolls over so it's available for the next month. So for our business overhead, we have Thomas Edison. He's 33. He's a 5A occupation class because he's considered an engineer, but he's also an inventor and an industrialist. And good thing he took out a disability policy because he lost his hearing, not just from the scarlet fever, but he suffered from ear infections over time, and it just kept deteriorating his hearing. So in order to keep his business open, which was, he was the mastermind of the General Electric Laboratory, in the event that he became disabled, he wanted to keep it going. So his monthly expenses were $27,000, but some of them weren't reimbursable, but $25,000 of them were. So he took out a policy for $25,000. It's a 30-day elimination period because you don't want to see this not paid, and then a benefit period for 12 months, and it can be increased in the future if he needs it as his expenses go up. And his premium is $25.07. Now we got business loan. You might recognize this guy. This is Walt Disney, 34. He's considered a 4A as an animator, and he has an income of $405,000. He took out a loan to cover the cartoon movies and such that obviously it went into the theme parks and everything else, but he first took it out for cartoon movies, and he wanted to make sure that this was going to be paid in the event he became disabled. So his monthly benefit was $11,000, elimination period 30 days, benefit period of 15 years, and if he paid the loan off early, he just cancels this policy. And again, he was diagnosed as having dyslexia. In addition, his premium was $2,061. Banks like to see these policies. So if someone's going to go for a loan, if they can show proof that they're going to be purchasing a disability policy that will cover the loan in the event they become disabled, that bodes well with the bank. So we talked about the needs for an individual, and then we talked about the needs for an individual business owner. Now let's talk prototypes for business owners looking to attract and retain their employees, so they can offer them life insurance, both short and long-term disability, dental, vision, accident, critical illness, and indemnity plans. In order for me to quote group, I need to know what's the name of the company, where are they located, what do they do, like what's the industry, and then there's a census. It's an Excel spreadsheet that's a census where they would put in the names of the employees, how many hours they work, what is their occupation, what's their income, things like that, so that we can run a quote. And then we would need to know what month we're shooting for. So like right now, I'd be shooting for possibly June or July to run some quotes. So why is group insurance offered to employees? It's a way to attract prospective employees, some new hires, and to retain existing employees. The cost is more efficient as a group than on an individual basis. And with 10 lives or more, there is limited underwriting. So if you have an individual that's a business owner perhaps that may have a health problem that can't get coverage through an individual disability, we might be able to cover him on a group plan because they don't ask health questions. Again, it's the law of large numbers. They're distributing the risk over a larger group of people. So less restrictive. I'm sorry. So the minimum requirement for group is literally 2 lives. Otherwise, one would just be an individual. So for group life, we can go from 10,000 upwards to a $500,000, or some business owners just say one-time salary. For the short-term disability, this is a weekly benefit. So on average, we'll do 60% to $1,500 a week, but this can be modified as well. Because it's short-term, it's going to pay for 90 days, or for 26 weeks is roughly a half a year. The elimination period, we don't want it to be immediate. We want to see if that cold is actually going to turn into a pneumonia. So you could choose an 8, 15, or 30-day elimination period. When we're talking about group, long-term disability, this is a monthly benefit. So this can go on average 60% to $6,000, but here again, we can fluctuate, that number can fluctuate. This could be a 2, 5, or age 65 benefit period and a 90 or 180-day elimination period. That's because the short-term disability segues right into the long-term disability. And group is priced based upon the number of bodies and the gender of the individuals. So in addition to the regular life, short and long-term disability, they can offer dental, vision, accident and critical illness as long as it's 2 lives and it's employer paid. It has a 1-year rate guarantee, and if 2 or more of these are being taken, they do offer a health and wellness screening benefit for both the employees and the dependents. So let's look at the underwriting for 2 to 4 lives. With 2 to 4 lives, complete underwriting. And by that I just mean the employee has to complete a statement of health, they have to answer medical questions, and physician information. When we're going 5 to 9 lives, we're looking at an employer completing a questionnaire. So the employer has to answer if any of the employees have been out for a lot of either sickness or sickness or injury. And also they have to know if any of the employees or if they're covering dependents have a history of any kind of heart attack, stroke, back condition, any kind of serious debilitating illness. And then when we're talking about 10 lives, it's guaranteed issue, which is great. There's no medical questions. And there again, when we're talking about a business owner and we're trying to get that person covered and they have a health issue, this is nice if they've got 10 or more employees because they don't have to answer any medical questions. In addition to the plans, particularly when we're looking at disability, they automatically get an employee assistance program. With the life insurance, they'll get the beneficiary support, the will and legal document assistance, travel assistance, and then these 4 other ones are not insurance, but they're discounts. So they can get laser vision done or get hearing aids done or get vision care or dental health done at a discount. Just think how much your business owners, employees will appreciate group benefits and these additional services. So here we have our group case study. This was a consulting business. There were 4 individuals, one of them being a CEO, but he also was a consultant. He requested quotes for life and long-term disability. And because it's a small group, all the lines were going to be employer paid. So with the group life insurance, he chose a very small benefit amount because he wasn't really interested in the life insurance. He really wanted the disability, but he had to take the bare minimum, which is the $10,000. It also includes accidental death and dismemberment. His monthly premium, $13.64, and over the course of a year, it's $163.68. So for the for the long-term disability, which is what he really wanted, he stuck with the 60% to 6,000, benefit period to age 65, elimination period 90 days. We've got the ONOC for 24 months, the mental substance abuse for 24 months, and his monthly cost is $91.40, and on an annual premium basis, just under $1,100. So we've covered individuals, we've covered individual business owners, we covered the employees of a business owner. Now we're going to talk about people who aren't eligible for disability, possibly. Doesn't mean they can't get critical illness, but most of the time they may not be eligible. And they may not be eligible because their occupation, or they want extra coverage because of family history, or maybe they're a stay-at-home parent, so they don't have an income. But everybody probably knows someone that's been touched by heart attack, cancer, or stroke. So back in the 80s, two brothers, Marius Bernard and Christian Bernard, one was a cardiac surgeon, one was a heart transplant surgeon, they actually performed the first live heart transplant. And they realized that after everything was said and done, the patient wasn't thriving. And the reason for it was because of all the financial bills that were coming in before they had the transplant, during the transplant, and after. So because of the burden of debt, the two brothers got together and created what they dreamed up, if you will, the idea of critical insurance to help pay these bills that had been accumulating. So the great thing about critical illness is it covers a wide variety of medical conditions, and this is just a sampling of some of them. Keep in mind that the insurance company that we use, it's not a one and done. So in other words, if your client purchases a policy and has a stroke, it doesn't just pay for that one thing. So here's an example of what I'm talking about. You have a client who's 38, they have a heart attack, and they purchased a $200,000 policy. They're going to get $200,000. But let's say a few years later, at age 42, they suffer a stroke. They're eligible for another $200,000. And horrible, but age 57, they're diagnosed with kidney failure. They're eligible for another $200,000. So some plans, like this one, will pay out multiple times. So in this instance, they're getting $600,000 when in actuality they only paid the premium for a $200,000 plan. Here we have Helen Keller, and again, Helen Keller, as well as other individuals, wasn't able to get disability insurance because she's a writer. And when we have people that are writers, individual disability companies don't like to cover them because their income can fluctuate. And it's hard for someone to document, are they working or are they not working? Now, that's not to say that some people, if they have, like with Lloyd's of London, we could get them covered simply because they might have a publishing deal. They might be an established author who has, written several books. But with Helen Keller, she's blind. She's age 42. She was a writer. She wasn't a good risk for disability insurance. But for critical illness, this was a perfect solution for her because it's going to provide her with a lump sum, and what she chose was $50,000. In addition, she also put what is known as a reoccurrence rider on it. And what the reoccurrence rider does is if she was diagnosed with cancer one time and then was fine, and then she had a reoccurrence of cancer, this policy would pay again. So this policy allows Helen to continue dreaming up ideas for books because she's going to be able to pay her bills. Her premium was $555. Where we use this, just as a little sidelight for this, is individuals who are the high wage earners and they have a stay-at-home spouse that's taking care of the kids. In the event that that stay-at-home spouse becomes ill, the high wage earner cannot take time off indefinitely to run the house, to tutor the children, to clean the house, to be a nanny, do all that stuff, in addition to taking care of the stay-at-home spouse. So what critical illness does is it allows him or her to have a lump sum of money to hire that nanny, to hire that tutor, to hire the housekeeper, whatever the need is, to make sure that he can continue to, go to work and earn the money that he needs. So critical illness can be used in a lot of different ways. So just keep that in mind. And then let's just kind of review. We went over individual disability insurance and why we need to get it. We talked about how to build a plan for those individuals. And then we talked again about how to build a plan specifically for individual business owners. And then how do we relay some sort of benefits over to the employees of that business owner. And then lastly, we talked about critical illness and how critical illness can fill a niche for certain situations. Thank you for attending. Being famous doesn't insulate you from becoming disabled. I'm going to ask about questions in just a minute, but before that, I just wanted to let you know about some upcoming conferences. July 30th through August 1st, we're going to have the Garrett Retreat. In September, ACP, and then XYPN Live, and then in October, NAPFA Fall. Next month, June 9th, we're going to have Jerry Skapiak speaking about annuities. Are they a good fit? So make sure you tune in for CE credits for that. And then lastly, I want to remind you that come January of next year, we are going to be hosting our LLIS Insurance Academy again. It will be from January 27th, 29th at the Sheraton Sand Key in Clearwater Beach. For those of you who are in the, maybe colder climates, this is a nice way to take a break from snow and enjoy the beaches on Clearwater. So at this time, I'll take any questions that you may have. Okay, so I have a question here. Just so I am clear, LLIS does work with business owners to put group life and disability policies in place. Yes, I'm the one that does that. So if you have a group situation, come to me and I will help you get a quote for life and disability, as well as the other ones, the accident, the dental, the critical illness, the vision, all that kind of stuff we can get covered. Any other questions? I didn't go into greater detail, but while we have a couple minutes, we do have access to Lloyd's of London. Lloyd's of London is a carrier that we can go to when you have individuals who have an inordinate amount of income and traditional individual disability doesn't cover that. We can layer over that with a Lloyd's of London plan, or people who have unusual occupations such as professional athletes, web content creators, podcasters. We can go to them and get coverage. So just wanted to throw that out since we have some additional time left. Any other questions? Okay. All right, well, if there's no more questions, I guess we'll, if you have other questions, make sure you send them in tomorrow, and I'll get them, and I'll answer them via the spreadsheet that we create with your questions. Okay, if there's no other questions, I'm going to go ahead and close this out. Feel free to reach out to me. You have my email address if you have any other situations that you want to run by me. Thank you for tuning in.